of insurance services. In the unit 1, we had understood the overall concept of insurance sector. Then we had undergone the different principles, the types of insurance. In unit 2, we have understood the structure of insurance, and today we will learn about the legal and regulatory environment which governs the entire insurance sector. So this unit 3 is going to be a bit theoretical in the concept. So we will be learning about the different acts, the different regulatory authorities who are governing the entire insurance sector and how did it evolve. So we will have a brief understanding on the Insurance Act, which came up in 1938. Then we will learn something about the IRDA, the Insurance Regulatory and Development Authority Act, which came up in 1999, the Companies Act, which of 2013, and about SEBI, the Securities and Exchange Board of India Act, which came up in 1992. So, as we have already understood about the concept of insurance, the laws or the rules which governs the insurance in India have been changing over the time, and the main objective has been to protect the interest of the customers, the policyholders, and to make sure that the industry of insurance works in a more safer and more smoother way. So, with keeping in eye that objective, there has been subsequent developments in the acts, or there had been subsequent amendments in the acts. So, the first Insurance Act was developed in the year 1938, and this act is the first major law which sets the basic rule of how the insurance companies should work. The functioning of the insurance companies have been mentioned in this act first. Then gradually there was nationalization of the insurance companies, the life insurance companies and the general insurance companies was nationalized. That means the government took over the life insurance and general insurance companies so that it can ensure trust among the policyholders. So when it is a government company, obviously the people or the public will have more faith and trust. Gradually, when public insurance companies were there, gradually the door was opened for the private companies also, so that they will have more number of products or insurance schemes available to the general public as per their needs. So later private companies were also allowed to enter the industry, giving customer more choices. So based on their different needs, they could offer different types of insurance schemes. Now, sometimes it occurred that there might be some issues or complaints arising from the insurance policy holders. So, like in banks, you have ombudsman to resolve the complaints quickly and fairly. Similarly, insurance ombudsman were also introduced, appointed. So, this system created the help to the policy holders that they could resolve their complaints more quickly and in a fair way. Gradually, few micro insurance products were also introduced. So these micro insurance products were specially made looking into the affordability of the low income groups people. So that was developed so that it can cater to a larger mass of people. Also, the Insurance Act, it had rules on money laundering, so that the companies, the insurance companies, do not misuse or conduct any sort of illegal activities with the funds which are pooled from the public. And subsequently, there were investment regulations. We had already discussed about the investment rules which are being given to the insurance companies, that they can invest the funds which are available in the terms of premium with them, So they can invest these funds in government securities so that the funds of the public is kept safe, and that can be returned whenever the policyholder claims for the amount. Then gradually the rural and social sector requirements were also taken into considerations, and insurance companies provided also coverage to the rural areas as well as the socially weaker sections of the society. Then there was also changes in the foreign direct investments. That means the limit of investment by the foreign investors was also increased to a certain level. So these are certain changes which has evolved from time to time since the advent of the insurance sector, so that it can be more safer and smoother. Now, let us first discuss about the Insurance Act which came up in 1938. So, Indian Life Insurance Companies Act, initially it was created in the year 1912. So, since last century, 1 century, there has been gradual developments in the insurance sector so that it can play a significant role in the upliftment of the society, and also it can cater to the entire mass of the Indian nation as a whole. So, Life Insurance Act, Companies Act came in 1912, and this was the first law which was created to regulate the life insurance companies in India. As we said that LIC was the oldest one. So, Insurance Act subsequently came up in the year 1928. This allowed the government to collect data and statistics about both the life insurance and non-life insurance businesses in India, whether run by the Indian companies or run by the foreign ones. So, as we have seen in the previous slides, initially there were public insurance companies, government insurance companies. Gradually it was opened for the private sectors to enter into the insurance sector, and then of course it was also the foreign investors were also allowed to invest in the insurance companies. So the Insurance Act in 1928 focused on collecting the statistics and data all relevant to the life insurance as well as non-life insurance businesses. So the goal was to understand the market better. So when there is a better understanding of the market of this insurance business, so of course they can gradually refine the rules and regulations for the betterment of the society. So that was the main objective. Then gradually in the year 1938, the Insurance Act was framed. So this act brought together or consolidated the Indian Life Assurance Companies Act 1912 and the Insurance Act of 1928. So both these acts were amalgamated and the Insurance Act 1938 was formulated. And the purpose was to strictly regulate the activities of the insurance companies, and most focus area should be to protect the interest of the policyholders who are availing the insurance schemes from the different insurers or the companies. And this act became effective in the year 1939 on 1st of July. Subsequently, the Insurance Laws Amendment Bill was made in the year 2015. This introduced the major reforms to modernize insurance laws and make the industry more efficient and transparent. So these reforms were made and such laws were introduced so that the credential or supporting or supplement documents of both the insurer as well as the policy holders can be more transparent, and subsequently there can be reduction in the complaints, and there can be authenticity of the insurance policy. After the year 2015, again the Insurance Amendment Act was made in the year 2021, which was focused mostly on the foreign direct investments. So they have increased the limit of the foreign direct investment companies from 49% to 74%. So here when they have opened the door for the foreign investment from 49% to 74%. That the objective was that the foreign FDIs can help in the sector growth, and there can be a larger increase in the economic development of the country. Now let us look into some of the most important provisions of the Insurance Act 1938. We are not going to go in detail of all the act sections of this act, but definitely I will highlight upon few major aspects of this Insurance Act. So registration of insurance companies, it focused on how the companies, that means the insurers, the insurance companies will be officially registered before starting a business, ensuring that only qualified companies operate. So they have laid down a procedure of which companies are qualified. The company should have a adequate number of capital, the company should have adequate number of personnel. So all those things have been defined, and those companies are only qualified to be registered as insurance companies. Then one of the most important provisions was maintenance and checking of accounts and valuation reports. So insurance companies were mandated that they should keep proper financial records. The regulators at intervals, they need to check these to ensure that the insurance companies are financially stable and they are also transparent. The end point is that whenever there is claims of different policies by the different policy holders, the insurance company should be able to claim, settle the claims or repay back the sum assured which has been assured in the policy. So that is why this is very much important, that a financial stability report needs to be generated by the regulators from time to time by checking the financial health of every insurance company. Now, the third one is investment and use of funds. There are rules on where insurers can invest money. This we have already discussed in the last unit. So there are different sections which describes where the what percentage of the amount will be distributed, will be invested in government securities, what percentage of the funds will be invested in other securities as laid down in the act. So that the rules have been laid down, which the life insurance companies or the general insurance companies need to follow. This ensures that the funds are used safely and responsibly. Again, insurers cannot overspend their management expenses. This protects the customers from high premium cost. Now, when the insurance companies are overdoing their expenses, obviously they are deficit of funds. So when they are deficit of funds, they will ask or call for a increase in the premium amount for the policy holder. So definitely there has been a limit which has been set for the expenses which need to be incurred by the insurance companies, and that is reflected in the Insurance Act 1938. The people who are selling insurance need to be licensed and their commissions are regulated to prevent the mis-selling. So it can be, there are, like in the stock market, the brokers also, they have a definite commission which has been fixed by SEBI. Similarly, in case of life insurance or general insurance product which is sold by the people or the agents, they should be first of all licensed, and the commissions which they get are also regulated by the Act. Insurers and agents cannot offer the illegal discounts or rebates to attract the customers. So there should be fair competition, and all the price tables and charts are laid down by the insurance in the Insurance Act. So it prohibits that any insurance company cannot give a heavy discount or rebate to sell their product. Insurance products and their pricing need regulatory approval to make sure that they are fair and not misleading. So all the prices of the insurance policy. That means the premiums which are laid down for the different types of schemes. Those premiums has to be approved by the regulatory authority, which is IRDAI. The IRDAI should approve it so that it is not misleading to any of the policy holders. Now, insurers must always have enough financial reserves to pay the future claims. This is what we had discussed, that they should always have a financial stability, and that means they should have that much adequate assets which will cover at least the liability what they have. So that much amount of reserves they should have. So they should ensure that they should be financially stable, so that in case of any sort of future claims, they should be able to pay the claims on time. This protects the consumers also in case there is a large loss. A proper legal framework ensures smooth functioning and protects the policyholders' right. And there are organizations like insurance associations, insurance councils, and tariff advisory committees which helps the standardized practice and support industry development. Regarding the insurance associations, insurance councils, and tariff advisory committee, we have already discussed in unit 2. So there are some functional bodies which helps to for a better regulation of this entire industry as a whole. Now, some key definitions has been given in the Insurance Act, which is 1938. So I will just tell the key definition which is given by the Act in 7A, which means any insurer being a company which is limited by shares and which is formed and registered under the Companies Act 2013, 18 of 2013, as a public company or is converted into such a company within 1 year of commencement of the Insurance Laws Amendment Act 2015. This is what has been defined exactly in the Act, and in which the aggregate holding of equity shares, this is the amendment, the aggregate holding of equity shares by the foreign investors, including the portfolio investors, do not exceed 74% of the paid up equity capital of such Indian insurance company. So initially it was 49%, and then it went up to 74%. So it should not exceed 74% of the paid up equity capital of such Indian insurance company, and the foreign investment in which shall be subject to such conditions and manner as may be prescribed, whose sole purpose is to carry on life insurance business or general insurance business or reinsurance business or health insurance businesses. So this is what has been defined in respect. It has to be registered under Companies Act. Its investment by FDI should not exceed 74%, and it should be operating solely as a life insurance business company or a general insurance business company or reinsurance or a special insurance company's business. Now they have also given the requirement of capital which has to be there with the insurance companies. It is mentioned in section 6. So this rule explains the minimum financial requirements an insurance company must meet to get registered and operate in India after the IRDA Act 1999 that came into effect. So what should be the minimum paid up capital requirement? Every insurance company must have a certain amount of paid up equity capital before it is allowed to start a business. So before that, it is mandated that they should have a adequate amount of paid up equity capital. So life insurance or the general insurance companies, they must have at least 100 crores as the paid up capital. Whereas if we take the health insurance companies, these are specialized insurance companies, they must have at least 100 crores paid up capital. And as well as the reinsurance companies which are only doing reinsurance, not any other life insurance or general insurance, they must have at least 200 crores as the paid up capital. So again, here it can be life insurance or general insurance. So for if you are doing life insurance 100 crores, if you are doing general insurance 100 crores. Now if it is only health insurance, you should have a capital of 100 crores. And if it is only reinsurance, then the capital, paid up capital increases to 200 crores. So these criteria have been set in order to have the insurance company should be financially strong, so that in case there is any sort of emergency or contingency or the claims are very huge, then they will be able to fund that policyholders adequately at appropriate time. Now, apart from the minimum paid up capital requirement, the insurance company also have to have a minimum net owned funds requirements. So apart from the paid up capital, every insurer must also have a net owned funds of at least 5,000 crore. So they should have this much amount of funds available with them. The logic is very simple. So whenever there is a huge demand of money at the end for meeting the claims, these funds will be helpful for the insurance company. So that is just to ensure that they are financially sound. So I'm just highlighting a few major sections of which are there in this act, but again there are so many other sections which also have been mentioned. So section 32C, that that sets the obligations for the insurer, that means the company, in respect to rural and unorganized sector and backward classes. So the section 32C is more focused on the rural and unorganized sector and the backward classes people. So after the enforcement of the IRDA Act in 1999, every insurance company of India were entitled to meet certain social obligations. So their focus was then diverted towards developing the people of the rural areas. So this section says that the insurers are required to offer life insurance as well as general insurance to the people who live in the rural areas. So they should also have schemes for the workers in the unorganized or informal sector, like the laborers or the daily wage workers or the small vendors. So they should also cater to their needs and have certain schemes which as per their affordability. They should also consider the economically weaker and backward sections of the society. So the section 32C mandates the different companies, the insurers or the insurance companies, to have different types of schemes adequately to meet the needs of such type of weaker people of the weaker sections. Now, the policies, these are few examples. The policies may include the crop insurance to protect the farmers from the loss of crops, and there can be other suitable policies, life insurance policies or the general insurance policies, which can cater to the needs of this rural or unorganized sector. But yes, of course, the premium will be substantially low, looking into their affordability. The section 39 of the Act says that every policy holder should have a nomination of the policy. That means one member should be nominated as which is mentioned in that form. He is a nominee. That means in case the policy holder dies, then the funds, which the sum assured, should go to the nominee, the name of the person which is mentioned in the form. So that is known as nomination by a policyholder. So section 39 allows a person to buy a life insurance policy on their own life, to choose who should receive the money if they die. In case the policyholder's death, then the other person, the nominated person, will be getting the sum assured. So the policyholder can name one or more people called the nominees who will receive the policy money with the policy when the policyholder dies. So suppose a person has a life insurance policy, so he has to write the name of his wife or his son or daughter, anyone who will act as nominees. So suppose he dies, then the person, his wife or the children, they will be receiving the money or getting the money. The money will be transferred to them, the nominee. So when can the nomination be done? So the nomination can be done while the proposer is filling up the form of the policy at the time of buying a policy, or any time he feels before the policy matures, he can also write the or give add the nominee to his policy. So at the time of buying the policy or any time before the policy matures. Changing or cancelling any nomination. Suppose the person has already written his nominee's name while buying the policy. So there are facilities where the policyholder can change or add or cancel the nomination anytime, but it has to be before the maturity of the policy. Now, what is the insurer's responsibility? Insurer is the insurance companies. Insurance companies' responsibility is that they must give a written acknowledgement confirming that the nomination has been recorded. Suppose you are going to change the nominee, or suppose you are going to add a nominee. So there the insurance company should give a written acknowledgement to the policyholder. Now, if the policyholder makes a change or cancellation, even the insurer must also acknowledge that. And for changing, suppose the person has already mentioned the name initially, and again the company, the policyholder is changing the name of the nominee, then he is allowed to do so, but the policyholder has to deposit a small fees for that, for changing the name in the records. So this is the section which is on nomination by the policyholder. Then section 45, this is also, I felt this we should know, that the policy not be called in question on ground of misstatement after 3 years. Now, what does this policy says? This section 45 protects the policyholders by limiting when an insurance company can question or reject a life insurance policy. So it is yesterday only in the unit 2 we had discussed that there are chances that the insurers or the insurance company, the evaluators, they can reject the policy. So they can either accept the policy or reject the policy. Or suppose they are accepting the policy, the premium can be high. So here this rule is for what should be the time period at which the policy can be rejected or questioned. So after 3 years, the policy cannot be questioned. Once the policy is issued, once the policy is accepted, and once the policy has been retained for 3 years, then beyond that the policy cannot be questioned or it cannot be rejected. So once 3 years have passed from the latest of the following dates, that means the dates can be the date of the issue of policy, the date of the risk coverage started. Risk coverage has started when you have started giving the premium. The date of policy, the date the policy was revived, or the date a rider was added. A particular slab or rider is added. So the insurance company cannot question or reject the policy for any reason, including misstatements or mistakes in the information given. Now, suppose the policy holder has given a misinformation about his health or about his income or about his family. So when the 3 years have passed or lapsed for the policy to be or totally issued and it has been already implemented, so that cannot be questioned or cannot be rejected by the insurance company. So what it means is that a policy becomes fully protected and validated after the 3 years of implementation. So within that 3 years, the person might have received some amount of money, like a money back policy. The riders are there. Like suppose after the end of 3 years, you get 10% or 15% of the amount of premium, that much, the amount which you have already given as premium. So that is a rider. Or suppose the policy you are paying every month the premium amounts. So after 3 years, it cannot be questioned. It is fully protected or valid. So it has to be now continued till the maturity. But yes, if any sort of fraud detection in the information is notified or it is noticed within the 3 years, then that policy can be questioned or it can be again called for question. If the insurer wants to question or cancel the policy, it must do so within the first 3 years. So how he can do it? If only there is a fraud, meaning that the policy holder has intentionally given some false information to deceive the insurance company. So if there is no fraud, then the insurer cannot cancel the policy even within the 3 years period. But if there is a fraud which you have noticed within the 3 year period, then the policy can be cancelled or the policy can be rejected. The policy was accepted initially, but it can be rejected within a period of 3 years, but not beyond that. Now, after this Insurance Act of 1938, let us move on to another regulatory or governing authority of the insurance industry, which is the Insurance Regulatory and Development Authority Act 1999. Now, the establishment of IRDAI, this is the regulatory body which regulates the entire insurance sector. So its origin was as per the recommendations of the Malhotra Committee in 1994. And the main purpose of this IRDAI was to create an independent regulatory authority and open the sector to private and the foreign players as well. So as we have already discussed that it was open for private companies to enter into the insurance sector. Some specialized insurance companies were also introduced, and also the foreign direct investments, proportion of investment of foreign direct investors also increased. So that was the major objectives, and the statutory body IRDAI was established in April 2000, and its headquarters is in Hyderabad. Now, the main objectives of this regulatory authority is to promote the interest and rights of the policy holders. So every policy holder should have clarity of the schemes and they should be able to get back their claims at accurate time and properly without any sort of hiccups or without any sort of issues. Then the next objective was to promote and ensure the growth of the insurance industry. As we said that gradually there has been a growth in the insurance industry due to different types of rules and regulations which has been implemented by the different regulatory bodies. Then the third point is to ensure speedy settlement of genuine claims and to prevent frauds and malpractices. So that the policyholders can get their claims within certain period of time shortly, and also they should reduce misinformation or frauds which can be by both the sides. It can be from the insurers, it can be from the policyholders. So that those things it should be reduced, and of course to bring in transparency and orderly conduct in the financial markets dealing with insurance. So when the insurance companies are also players in the financial market, they are also investors in the government securities. So there need to be certain level of transparency and of course discipline while dealing in the financial market. So these are some broad objectives and the purpose behind having this act, which is Insurance Regulatory and Development Authority Act. Now, the composition of IRDA as per section 4, that it should have a chairman, it should have 5 full-time members, 4 part-time members, and they all have to be appointed by Government of India. Now, the main mission, the broad mission of the authority is definitely to protect and safeguard the interest of the policyholders and to promote the growth of the insurance sector in a very much efficient manner. So, this not only includes life insurance, it includes general insurance, it includes the annuities and pension products. Then a stronger insurance sector helps to provide a long-term funds for the company's economic growth also, and also to maintain high standards. The IRDAI sets and enforces rules to ensure honesty, financial strength, a fair practice in dealing with the products and settling the claim, competence, because there are so many private sectors and foreign investors also, and they should have a fair competency among all the insurance companies as well as agents. The fourth mission is to ensure quick and fair claim of settlement. So, quick and fair claim of settlements has to be there so that trust from the policyholders towards the insurance companies can be generated. The authority works to make sure genuine claims are paid up quickly. It also acts to prevent frauds, mis-selling, and other wrongful activities. A strong grievance redressal system is a part of this mission also. So, as discussed earlier, they have introduced ombudsman for any sort of grievances to be redressed at very short period of time. For any sort of issues or claims related grievances which are being made by the policyholders, that also can be redressed by the help of ombudsman. Mis-selling, any sort of higher commission which everyone is claiming, that also will be sorted out because they have set a benchmark or they have set a certain level of commissions. The table charts for the rates and all, everything has been properly laid off by the development authority so that it will prevent any sort of frauds. And of course, quick and fair claim settlement is the main purpose. It ensures fairness and transparency. IRDAI promotes fair and transparent practices in the insurance market. It also builds good information system to monitor the financial health of the company. It takes action when rules are not followed. So if standards are not met or rules are ignored, then IRDAI has the full power to take corrective actions. And also it regulates, it encourages self-regulation by the different insurers. It motivates the insurance companies and the market players to regulate their day-to-day activities responsibly while still following the regulatory framework. Now, there are some section of the IRDAI Act. Section 14 displays the duties, powers, and function of the authorities. These are more or less similar to what we have already discussed. So, the IRDAI is responsible to issue to the applicant a certificate of registration. Any company who wants to register itself as an insurance company, the IRDAI has the duty to issue its applicant a certificate of registration. Then after the expiry of the registration, it has to renew it, modify, withdraw, or suspend or cancel any sort of registration. The Act is liable for protection of interest of the policyholders in matters concerning assigning of policy, nomination by policyholders, insurable interest, settlement of insurance claims, surrender value of the policy, and other terms and conditions of contracts of the insurance. So every term we have already discussed: what is insurable interest, how the settlement of insurance claims will be done, surrender value is the sum assured. So all these things will be already mentioned in the policy scheme, which is ultimately accepted by the company and which is proposed by the policyholder. So protection of interest of the person or individual or the policyholder is matter of concern which are under the purview of this Act. Specifying requisite qualifications, code of conduct, and practical training for intermediary or insurance intermediaries and agents. So IRDAI conducts several training sessions. They conduct several workshops so that the intermediaries or the agents who are going and connecting with the people, what should be their approach, what all things they should tell, how they should be fair and transparent in delivering about the products. All these trainings are being given by the IRDAI to the agents and the intermediaries. They specify code of conduct for surveyors and loss assessors. So the persons who are evaluators while evaluating the proposer's form, so they have a code of conduct in which the surveyors or the persons, yesterday we were talking about ranking system. They have to have give a particular score to the format or form which they receive, the numerical method of accepting it. So they have to give a numerical digit or rank to every form, so that this rank will help to know whether the form is eligible to be accepted or rejected. Now, it promotes efficiency in conduct of insurance business. It promotes the regulating professional organizations connected with the insurance and reinsurance business, and also the duties are towards levying fees and other charges for carrying out the purposes of this act. Section 25 says the establishment of insurance advisory committee. Regarding the advisory committee, its formation, its functions, we have already discussed in unit 2. So the authority may by notification established with effect from such date as it may specify in such notification a committee known as the Insurance Advisory Committee. There are insurance councils separate for life insurance and separate for general insurance, and there is also Insurance Advisory Committee which comprises members from the IRDAI, and there are some other members which are 25 in numbers excluding the ex officio, who represent the interest of commerce, industry, transport, agricultural, customer fora, surveyors, agents, intermediaries, organizations engaged in safety and loss prevention, research bodies, and employee satisfaction in the insurance sector. So there are people from within ex officio members from within IRDA, and there will be 25 other members representing from different diverse sectors in the Insurance Advisory Committee, so that there can be a purposive decision or disciplined decision which can be taken on different issues that arise. The chairperson of the members of the authority shall be ex officio chairman and ex officio members of the Insurance Advisory Committee. The objectives of the Insurance Advisory Committee shall be to advise the authorities on matters which are relating to the making of the regulations under the section 26. Now let us come to the Companies Act 2013. Now Companies Act 2013 was introduced in order to modernize companies law in India and make the businesses more transparent, efficient and accountable. So they are accountable to their stakeholders, so it has to be more fair and purposive and efficient, and of course they should uplift the entire economy of India. So that was the main purpose. So Companies Act was exists to encourage investment. The Act creates rules that makes it easier and safer for people to invest in companies. So this helps the companies to raise money and to grow. So they can collect money from the public by raising funds through IPO. Avoid duplication and conflicts in the regulations. So different sectors have different regulations. So the Act tries to remove the confusion by making sure that all the rules do not overlap or conflict within each other. So they have made it more simpler, which will be applicable. Some rules are applicable to all the sectors as a whole. Some rules are applicable for different or diverse sectors. So promotes simpler and cost-effective compliances. It introduces, the Companies Act has introduced easy and modern processes so that there will be less number of paperwork and there will be more digital filing or compliances, so that it can lower the cost of the company, compliance cost of the companies. Then the other purpose was to protect the shareholders' interest. The act ensures shareholders, especially small investors, have a say in the company's decision. Every person who is a shareholder have a say in the company's decision making. It has better protection of their rights and more transparency about how the company is run. So any person who is a shareholder is again being intimated by the company about the different financials or or the informations which are publicly announced by the company from time to time. Support economic and social goals. The law aligns companies' operations with larger national goals such as economic development, a good governance, and social responsibility like the CSR. These are few statements which a company, which has been definitions which has been written in the section 2 of the Companies Act. Financial statement, it is in section 240, which includes that a financial statement should have a balance sheet at the end of the financial year. It should have a profit and loss account which projects the income and expenditure of that particular financial year, a cash flow statement for that financial year, a statement of changes in the equity if it is applicable, and an explanatory note which is annexed or forming a part of any document referred to as subclause 1 and subclause 4. Similarly, they have defined, I've just taken few definitions. They have defined what do you mean by a financial year. This I think every one of us knows about it. Financial year means a period ending on 31st day of March every year. And the section 251 defines the key managerial personnel in relation to a company, that is the chief executive officer or the managing director or the manager, the company secretary, the whole-time director, the chief financial officer or such officer as may be prescribed. So key managerial person is the person who is in the top management. So it can be a CFO, it can be a CEO, it can be a MD of a company. So this is how they have coined the definition of the key managerial personnel. The section 3 of the Companies Act defines the formation of a company. So how many people have to be there, should be there in a company. So a company can be formed for any lawful purpose, for any benefit of the society. So there can be different types of companies. So public company needs 7 or more people, private company needs 2 or more people, one person company can have just one person who forms a private company by himself. So to form a company, they must sign a MOA, Memorandum of Association, and fulfill all the registrations requirement under the Act. Then what is this memorandum? Memorandum of Association is like the constitution of a company. It's like the registration of a company, formation of a company. So it contains most important details about the company when it is being formed, like the company, what is the company? The public company name must end with limited company, such and such limited company. A private company must end with a private limited. Registered office, the state where the company's registered office is located. So in the MOA, all these things has to be mentioned. Company's name, where is the registered office of the company, objectives of the company, the vision, mission, the purpose why the company has been formed, and the liability of members. It states whether the company, whether the members' liabilities are limited or unlimited. Limited means it is limited up till their shareholding, and for unlimited it is unlimited for that shareholders. For companies with share capital, the total share capital of the company which is existing in the market, how the capital is divided into shares of a fixed amount, number of shares each subscriber agrees to take, and each subscriber must take at least one share. So all these details has to be mentioned in the Memorandum of Association. And for one person company, name of the person who will become a member if the sole subscriber dies. So in case if it is a company which is having the owner as one person, then who is going to be the member after his death? So section 7 also tells about the incorporation of the company, how the company has to be incorporated. So there has to be few documents which has to be filed with the register, like MOA, like the declaration by advocate and a person named as director or manager or secretary, along with affidavit from the subscribers and the first directors that they are not convicted of any offense, not found guilty of fraud, misfeasance, breach of duty during the preceding 5 years, and documents contain the correct and complete information. So they have to submit the document regarding the person who is in the top level management, about their entire history, about their past experiences and their past achievements during the last 5 years. The address for correspondence till its registered office is established. Particulars of name, residential address, nationality, and other particulars of every subscriber which proof of identity. Particulars of the first director, their director identification number, the residential address of the director, nationality, and the proof of identity. And the particulars of interest of the first director in other firms or bodies. Suppose the director is also having any stake in the any other company, or suppose he is having any shareholding in other company, that also has to be made transparent during the incorporation of the company. The registrar shall register the documents and issue a certificate of incorporation to the company, and the registrar shall allot a corporate identity number, CIN, which is included in the certificate. Now, we were just discussing about the financial statement, which will have all the documents like the balance sheet. Financial statement will comprise of balance sheet, the profit and loss account, the cash flow statement, and certain other documents as it is given in the Act. There are also Act which is describing the CSR activity of a company. Section 135 mandates that the company should go for CSR activity. So every company who is having a net worth of 500 crore or more, or turnover of 1000 crore or more, or a net profit of 5 crore or more during any financial year, should constitute a CSR committee of the board with 3 or more directors, including at least 1 independent director. So they should have a CSR committee. Every organization which is having such financial status should have a CSR committee. Now the board's report under section 134(3) shall disclose the composition of the CSR committee, and the CSR committee shall formulate and recommend a CSR policy indicating the activities in the schedule 7, recommend the amount of expenditure, monitor the CSR policy. So you should have the company are advised to have a series of activities for CSR, like suppose they are going to open schools, or suppose they are funding to any college or schools or any other orphanage. So there can, or they are suppose investing in any park. So these are certain activities which can come under the CSR policy. So they have to define what is the amount of expenditure they have done in that financial year in the CSR activities. So the board shall approve the CSR policy, disclose contents in its reports, and place it on the company's website. Ensure the activities of CSR policies are undertaken. So in every financial year, they should have a series of CSR activities. They should also have in their budget the amount of expenditure that has to be done within the CSR activities, and again they have to show that this much amount have been spent in the CSR activity for that particular year. The board also ensures the company spend at least 2% of the average net profits and of the three preceding financial years on the CSR activities. This is a mandate from the regulatory authority, that the company has to pay 2%, has to spend at least 2% of the net average profits of the 3 preceding financial years in the CSR activities. Now, section 149 says that who can be the board of directors of the company, and section 166 says about the duties of the directors. Now let us come to the next act, which is Security and Exchange Board of India Act 1992, SEBI, which we are all familiar with. It takes care of the regulatory regulations and rules of the stock exchange. The objectives of SEBI was to regulate the activities of the stock exchange. One of the prime objective is to protect the rights of the investors and ensure safety of their investment. When the investors are trading in the stock market, the regulations or the procedures has to be safe enough so that their money is remaining intact. To prevent the fraudulent and malpractices by having balance between the self-regulation of business and its statutory regulations. To regulate and develop a code of conduct for intermediaries such as brokers, underwriters, etc. So they have a fixed commission. They have a margin which every broker should have. All the rules and regulations have been prescribed by SEBI for different stakeholders. It can be the investors, it can be the brokers, it can be underwriters or any other players of the stock market. So there are mostly three functions of SEBI: protective function, development functions, and the regulatory functions. The protective function says that SEBI protects the investors' interest, like SEBI monitors the market to prevent the manipulation of stock prices. So it prohibits the insider trading. That means any person who is working in the company should not disclose the insider information so that it will have a havoc in the stock market with price fluctuations. SEBI acts against the scams, which scams and misleading informations and market frauds. SEBI educates investors. SEBI runs the awareness programs and helps investors make informed decisions. So they have several programs which is running pan India in order to make the investors aware about different types of investments, and it ensures transparency and honesty in the securities market. So these are some protective functions. So development functions of SEBI includes developing and modernizing the security market. There has been development in the trading of the security market. Now it is completely digitalized. These functions helps to train the intermediaries. SEBI promotes not only training the investors, it also trains the intermediaries, the agents, the brokers. They have been trained so that they can properly communicate with the investors. It also encourages stock market activities by permitting the internet trading. That means it is completely automated. It makes the underwriting optional to reduce the cost of issuing the shares, and also it allows IPOs to be launched directly through the stock markets. Some other function is the regulatory function. SEBI regulates the stock market to ensure a fair, transparent, and orderly operation. It regulates the stakeholders of the market by setting a fixed rules, regulation, and code of conduct for the different intermediaries like the merchant bankers, brokers, sub-brokers, underwriters, share transfer agents, and trustees. Private placements are made more restrictive to protect the investors' interest. Registrations, the SEBI registers all intermediaries and mutual funds, monitors their activities to ensure that they follow proper rules, regulates a company's takeover, mergers, and acquisitions. It also, SEBI conducts interval audits, inspections, and investigations of stock exchanges so that adequate transparency is maintained. So section 4 talks about the management of the board. This section explains how the board of the company or regulatory authority is structured. The composition of the board consists of chairman, 2 members of the officials of Ministry of Finance, 1 member from the RBI, 5 other members from the central government, at least 3 of whom must be a full-time member. And the powers and management, the general supervision, direction, and management of the board affairs lies with the board as a whole. The chairman, unless regulations say otherwise, has the power for general supervision and direction. and the appointment of the members are done by the central government. The other members from the Ministry of Finance and RBI, they are nominated by the respective authority. The chairmen are appointed, must be appointed of persons who has ability, who has a strong background in finance, economic, accountancy, administration. This is